Hi, I'm Andrew Kirsh, co-founder of Sklar Kirsh. On this podcast, I interview industry leaders. You'll hear their real-time opinions on today's market, their background, unique career highlights, and guidance for newcomers to the industry. This is the Kirsh Connection. Welcome to another edition of the Kirsh Connection. Today I have Lee Beck, the president of Forum Investment Group. Lee talks about what makes Forum special, the Forum funnel, how they do deals throughout the capital stack, whether it's being the operator sponsor or providing JV equity or providing debt up and down the cap stack from stretch senior to pref to mezz. It's an interesting conversation with Lee Beck that I hope you will enjoy. Welcome to another edition of the Kirsh Connection. I'm here today virtually with Lee Beck, the president of Forum Investment Group. Lee, how you doing today?
I'm doing great, Andrew. Wish it was in person, but this is second best.
We'll do a sequel in person in the studio, so that's okay. This will just be the appetizer.
Perfect. Looking forward to it.
So where does this podcast find you today?
I'm actually in Boston today. I had some meetings with some family offices, institutions, kind of an update on the state of the markets, especially relative to real estate and the verticals that we operate in. And it's beautiful here. It's 60 and sunny. And when you're in Boston, 60 and sunny, you're in shorts and a t-shirt. So obviously I'm glad it's May almost instead of January.
It's funny that you say that. I went to Northwestern, and I know my listeners are sick of me talking about Northwestern, but being an LA kid, when it was, I don't know, let's call it the 40s or 50s, I was in my parka and, sweaters and everything. And everyone from Chicago, they were in flip-flops and shorts and a t-shirt. So I'm sure that's how it is today in Boston.
Well, you know a little bit about, we've spoken before, growing up on the Canadian border with 600 cows as your best friends. I get that joke when I traveled to New Jersey. I thought that was the Southeast to me, and weather made a big difference in terms of climate, snowfall, gray skies, etc. So yeah, I get that joke.
I love it. All right, let's touch upon Forum just on a high level, and then we'll do a deeper dive later in the podcast. But for my audience who may not know about Forum, what is it and where do you play in the real estate world?
Yeah, I'll be short and we can get into any tangents you would like to, but we're really proud of our 19-year history. We operate in over 25 states where we choose to operate, and you'll hear this thematically through our investment verticals where we think through where is their net population growth, where is their net job growth, where is their low regulatory barriers, and where is their high prevalence of business interest. You don't see us operating in Massachusetts. I referenced I was in Boston today. We're not here because some of those factors don't play out well in our fundamental reviews. And we're really proud that we've put over $7 billion to work across development, acquisition, and lending, primarily in the multifamily category. Obviously, there's the four horsemen of commercial real estate, but when you think through development or acquisition, it's purely multifamily. That's where our focus is. That's where our expertise is. Lending will be a little bit more diverse, where we'll lend. We'll talk about that, I'm sure, later. Multifamily primarily, but also student housing, which is a close cousin, select industrial, and even select retail when it makes sense.
And so do you guys see yourselves as both providers of capital, both debt and equity, but also operators, sponsors at the same time?
We do, and that's really our value proposition. It's very rare to find a specialist that actually has internally a vertical that includes development, that includes acquisition, includes lending, and all those teams sit on the same floor in our Cherry Creek, Denver office and communicate to each other. And what that creates is what we call the Forum funnel. It creates this off-market pipeline of investment opportunities that may have started as a lending inquiry, it may have started acquisition, it might have started in development, but evolved into different investment opportunities across the spectrum. That's where our real secret sauce is. Today we have over $2 billion in off-market pipeline opportunities to execute on. We're long on opportunity and short on capital in many ways.
Wow. All right, we'll get more into it. You touched upon about growing up on the Canadian border, so give more detail. Where did you grow up?
Yeah, I usually use this as a reference because when I talk about New York State and the Canadian border, I have to remind everyone in Manhattan and Westchester, there's actually more state above them that goes north. Because if you see it in New York City, they asked me if I'm from Westchester. So think about an hour north of Lake Placid, about 6,000 acres, open dairy farm. I thought every kid woke up at 4 a.m. And chased cows that were outside of the broken down fences. And I thought 9 months of gray skies and snow was typical. That's what you grew up with. When I left that area, I realized that was atypical and probably not going to be relocating back. Although I was very fortunate to grow up in a community like that with the foundation set, with a father that we didn't own the farm, but we worked on it, an uncle that went to West Point, another uncle that was an enlisted officer. And so, I grew up with this context of listening a lot more than I spoke to these guys that were bigger, stronger, faster, and a little tougher than me. But I loved where I grew up. It was just a very different area than, where I live today.
Yeah, and then tell me about college and post college. Your first job or two.
Yeah, college was simple. I was lucky to be given some genes by mom and dad that allowed me to play at a high level athletically. And this was back in the day where you played three sports a year. So I was recruited for football, baseball, and hockey, believe it or not, back in the day. And it was a very interesting conversation at the kitchen table where I sat down with my two uncles and my dad, and they looked at who was giving me money to play what, and they decided you're going to play football at this university because they're giving you the most capital and we don't have any. And they got up and walked out, and I was like, I guess I'm going to play football at this university, and that's how it's going to play. So started off at a Division I school, figured out I was a small fish in a big pond, and transferred to a Division I AA school, played football there, and actually played minor league baseball out of high school back in the day when you could. And that all changed through some injuries in football. And not only did my participation change, but life perspective changed as well. And after graduating college, there's a bunch of unfolding of how I got here. And I still look back and say, this is an interesting ride, to say the least.
Wow, you were Deion Sanders, football, baseball. I only played one sport in college. I played baseball at Northwestern, and it was it really shaped I would say my professional career of everything that I learned playing in college sports. Wasn't the best college baseball player, but good enough just to survive for 4 years.
Yeah, that's what the good baseball players or good athletes always say. Like, oh, it's all relative, or I wasn't that good. So obviously, you played at a really high level, and I really respect the school. Northwestern's a beautiful campus, a great school, and a lot of friends that went there. So everyone that I know that came out of Northwestern seems to be pretty grounded. That's the compliment I'd share across all the alumni.
Ah, appreciate that. And so, where after your playing days were over, what was next for you?
Yeah, I pursued and offered a graduate assistantship at a university in New York where I wanted to be a college football coach. Just thought that's all I was going to be. So pursued a master's degree. And if you're a GA, you basically are paid for your graduate degree by the university, but they own you. So you work there 24/7. I loved it. It was a great experience. And then I was recruited by another university, Colgate, to come on and coach and teach Syracuse University coach. And I say the teaching, you're really an assistant to a professor, really executing. So I feel bad for some of those students that really paid for the full professor, but maybe when they were working on a research grant, I'm coming in to teach his notes. Probably not the most desirable outcome that a lot of these students would face walking into the classroom, but I enjoyed it. That ultimately ended up into a career of financial services, which is a longer story. But my brother bridged me into that as he was an analyst in the paper industry, and it just one thing led to another. And I still look back on and wonder how we got there so quickly. But great experience, learned about work ethic, time, energy, and I still take a lot of those attributes from the coaching experiences at those universities and carry them to today.
I mean, it's incredible how many successful college coaches started as a graduate assistant and worked their way up through the ranks. And, 10, 15, 20 years later, they're leading big time Division I programs to major bowl victories or national championships. So, how did you end up getting into the real estate business?
Real estate was a bridge. Let's take it all the way to about 2018. There's a large gap, obviously, in time that we're alluding to. But in 2018, I was at a private equity firm and we were underwriting investments, looking at making minority or majority investments in wealth and asset managers around the world, meeting with 400 CEOs a year. I was introduced to Darren Fisk, the CEO and founder of Forum, as Darren had built a premier real estate firm, but was being asked by some leading RIAs, wealth advisors, if they could, if Forum could construct their investment capabilities in a structure that would allow them to offer them to their clients in a more scalable way. And Darren was introduced to me by a mutual friend with the idea of, hey, I don't know anything about investment management, or I'm learning a lot. Is there someone that can help me think through the construction of these vehicles and provide my investment IP from a real estate perspective to the broader wealth management marketplace, institutional as well? We were introduced, long story short, I said, you really don't need our capital. You're not asking for that. I'm not looking for money, but I'll be a senior advisor, which I did for the next 3 to 4 years for Forum, and really just guided Darren on, here's how you should think about in terms of hiring. Here's what you should think about in terms of partnering. Here's what you think about structuring, et cetera, to build the investment platform, albeit being fed by the real estate expertise. Fast forward those 4 years, Darren came to me and said, would you come on and lead our investment management platform and the entire ecosystem? I did that. And then he asked me to be president roughly a little over a year ago, year and a half ago. So the real estate side came on later in the career, right? It was really the investment career that I had, structuring, underwriting, investing over a good 25-year period, when I then married it up with real estate. And I really loved what Darren and Forum were doing in a differentiated capacity at Forum that I thought had real demand in the marketplace. So hopefully that gives you the arc of being brought into an area of expertise that I still was learning on a day-to-day basis, and really have a great team to partner with on that.
All right, so and then you started the conversation talking about Forum from a high level of how you guys play really up and down the cap stack as operators, as debt providers, as equity providers, mezz, pref. The inbox of your team must be just overflowing with brokers and other counterparties because you do so much. How did Forum? I guess end up with so many verticals. The traditional, private equity companies, stay in their lane, or I shouldn't say stay in their lane, just have a particular lane, or maybe multiple lanes. Operators have their lane. You guys have the entire freeway.
We do. And I think it takes a little bit of a step back to articulate that, but I could probably do it in under 60 to 90 seconds, because what you're asking is the foundation of why we clearly have a differentiated exposure in the marketplace. And we think of ourselves differently. Obviously, the sun does not rise and set on Forum. We think it does. So we still have areas we're trying to improve. But if you go back to 2007, when the current CEO and founder started this firm, just prior to that, he was at Johnson Capital leading all their funding initiatives to developers or across different commercial real estate sectors nationally. Darren Fisk observed, a lot of these companies obviously lead with the construction and the idea of it, whether it be in multifamily, whether it be in office, et cetera. But a lot of them don't have a strong discipline on the finance side. And we all agree with real estate only gets in trouble because of either you don't manage your financing well or leverage. It always comes down to debt. So he launched Forum in 2007 with a construct of, let's start off with finance being the front and center initiative, and then apply it where we think there's opportunity. Forum started with 3,000 developments, units from 2007 to about 2010, 11, 12. And that vertical was pretty established, strongly led by Darren Fisk. But if you think on that back end of the global financial crisis, we're thinking 2012, 2013, he was seeing a lot of great properties in existence from being held by stressed owners, stressed for different reasons that we're seeing today. We'll come back to this, I'm sure, later. They needed refinancing, bridge, or it's just an outright sale. So we built an acquisition team and a second vertical inside Forum to say, let's buy these properties at relatively 30 to 35% below what it would cost us to build them. And acquisitions started building in the funnel, getting up to about 20,000 units across Forum. In 2018, some of the largest banks, the super regionals and regionals, came to Forum and said, we're not lending to cost, or we're not lending to value or to build at 80 anymore, 90. We're only lending at 50, 55, 60. And we see in the equity coming in at the same levels. It's called 15, 20, 25. There's a bridge that we all talk about in private credit today that needs to be filled. There's a space. And we would love for you to be a lender alongside us. So the banks actually came to Forum and a lot of developers and said, would you be the lender in the pref mezz or JV equity, in addition to what the banks have kind of pulled back from? And Darren saw this opportunity to diversify the firm further, lifted out a team from EverWest and Denver. They've been operating together for over 15 years, put them in the Forum. That was the third vertical. And more to come today. That gets to 2026 when you think about that operating in 25 states, putting the capital work into different verticals. So it was built with a design of, hey, there's opportunity. And Darren always says this, and I agree with him. He didn't want to manage kind of to a cycle. He wants to manage through cycles. And you can only manage through cycles if you have different operating verticals that apply to the economic, currency, political, and market environment that you have every 3 to 5 years. So that was the thesis behind it, and it's paid us back really well. Hence that Forum funnel of off-market pipeline opportunities.
No, that's a great explanation. We've been in I'd call it a choppy market now for 4 years, right? Since 2022. And yeah, and, half of our client base will, say to me, Andrew, what could you possibly working on? I'm not seeing any transactions, meaning my client saying, we don't see any transactions that make sense. And yet the other half of our client base, they are active and they are finding opportunities. Maybe they have a discretionary fund and they're able to put out money and not rely on, institutional capital who's still reticent of going all the way in on today's market. Or there are operators who, just don't think prices have fallen enough to make it work, or that the return expectations of their equity is too high for what they can generate. And so I've got this like dichotomy of clients who are transacting and clients who are not transacting. Where is Forum? Where are you guys transacting today?
Well, it's an interesting summary, well framed. I'll start off by saying we get this question all the time of, hey, I really like a high yield, high distribution, and opportunistic. I'm like, that doesn't exist.
Yeah.
Like, I get it. That sounds great, and we'd love to deliver that to you, but I don't think it exists. It's either or. And also, you touched on the institutional uh, interest being narrow, let's call it limited. This is, and we can source this from a number of different contents. This is the lowest we've seen institutional investment portfolios, their lowest level of real estate allocations in over 25 years. So when we walk into an institutional family office or even a large wealth advisor, which I would put on par with a lot of institutional investors in terms of their knowledge, scope, and capacity, when they say we're really not interested in real estate, we haven't been there lately. I'm like, I know, of course. Like you're not the first one we've spoken to, and we see where allocations have been. Um, but we haven't bought a property up until roughly in the last 4 months in over 5 years because it
Wow.
just didn't pencil. It really didn't. We saw a lot of cheap capital that was easy to access with a lot of new participants in the market for all the reasons that we know of 28, 2019, 2020, 21, of where rates were and the lending capacity was. We just saw a lot of mistakes being made in the market. We thought it's only going to be a matter of time with this unfolded. So we didn't acquire, and it's really hard for a real estate firm to talk about how we're not acquiring anything because we wanted to be patient. It didn't make sense. And number one, number two, we had 8 developments, I think 2 years ago, and we shelved them all. Developments in the last 2 to 3 years really didn't make sense, especially when we look at the cost inputs. And we can talk about that later. We just went into one about a year ago in San Diego because our land basis basically ended up being about a net zero. That was really the impetus, and plus the opportunity where it was located in San Diego was a prime real estate location. So we went vertical with a partner in the area that we've worked with before, and we feel really good about that outcome. But we see that unlocking a little bit. So where are we? Where are we going? We still think right now, primarily buying at 25 to 35% below cost, brand new stabilized properties in multifamily. This is one of the greatest acquisition opportunities we would argue we've seen in 20 years, or at least the firm has seen in 20 years. And people ask us about value add. I hate to talk about it this way, but we think value add is a little bit of a dumpster fire. We think there's a lot of discussion around value add, but we think it's a very high cost, and the cost inputs are extremely high. We're not participating in that space. But there are opportunities in that 80, 90s vintage, which only needs, let's call it a light value add, that there's no bids out there. And if you have a development expertise and an operating expertise where you can manage those properties, there's a bid that should be present. And we think we can take advantage of that kind of market lack of acceptance in that 80s, 90s low value add component in acquisitions, and do a little work and really generate a high NOI. So that's on the acquisition front. And I'll just briefly touch on lending and development. Lending, we've been lending obviously since 2000 continuously. It's been in the pref and mezz, but we see that evolving into the JV equity, if you will, LP equity in 2027. We see that opportunity existing. And then development, we can dig down a little bit further. But as you said, as I mentioned earlier, we haven't done anything in a few years except for one opportunity that we thought was truly differentiated. But that crack is starting to open up. We see some co-GP deals we're going to be coming to market with soon. And there's an opportunity there. And we also see we want to build a basis right now because we think cost inputs to development are only going to be going up from here. They're not going to be going down. And so there's some interest there to start putting some, let's call it shovels in the ground in 26 and into 27, where we wouldn't have said that over the last 2 to 3 years. Sorry for the long overview, but hopefully that answers your questions or starts to answer some questions.
Yeah, and it sparks many questions, basically. I mean, if you say 80s construction to an institutional JV equity provider, they will think that you just spoke so badly about their firstborn child. I mean, they would never, think about doing another 80s construction deal, especially in the Sunbelt. And yet, I'm talking to more and more operator sponsor clients who say, guys, this is the time to get into, maybe this light value add 80s or 90s. The pricing is unbelievable compared to what it was just a couple years ago. There's a dearth of capital that is chasing it. So the opportunities are endless, but it's so hard to find the conviction from capital providers. Maybe it needs to be more of the syndications, family offices, those that have been able to raise discretionary funds from non-institutional type fund investors. These operators feel, look, operators always feel they're going to make a mint, but they really feel they're going to make a mint in a couple years, and that these capital providers are going to look silly. Gosh, we really should have been chasing this 80s product and not these newly constructed real estate opportunities where the yields just aren't there.
Yeah, well, Andrew, you have a really good handle on, these verticals and this space. So I'm not telling you anything you don't know, but let's be candid. LP Capital is still very skeptical.
Mm-hmm.
Um, and when we talk about this is all about supply and demand, is what you're alluding to. I mean, the supply is falling off a cliff right now. We still think in areas like Denver in our backyard, that's going to take longer. I think that's still 2027 because it was oversupplied. And you can see it with the comps. But there's a lot of markets where the supply is coming off completely and demand is continuing to rise. Net job growth, net population growth, strong business environments, as I alluded to earlier, and the regulatory framework is constructive, where those bids for those brand new stabilized properties, yeah, you can buy it at 25, 28, 30% below cost, but there's bids in that market to own it because it's stabilizing, it's cash flowing, and you have a lot of renters that say, hey, I can leave this A or B property and for the same money move to this brand new property that's been offered in market and get an upgrade in terms of my living environment. That's leaving these 80s and 90s multifamily properties at no bids. Nobody's bidding it. So the price points in these, you could go in with the right capital and the right underwriting and acquire great properties with a light value add, get ahead of this curve where supply is falling off a cliff and only going to continue to for the next 3 to 4 years, and demand only going to rise. You're in a really strong market to now have positive NOI growth and 2, 3, 4, even north of 5% NOI growth without leverage in a marketplace that just didn't plan for it or didn't have capital to acquire at the time. And 5 years from now, everyone's going to scratch their head and be like, "Why didn't I do that?" Right? It's the it's a little bit of the canary in the coal mine, but sometimes that analogy can get lost when you frame it. With is it one direction or the other? We agree with the framework you're talking about when you started that statement.
Yeah. Look, there are markets that have not been traditional markets for capital that are seeing positive lease trade outs. Upper Midwest markets, Chicago suburbs. Before you, we had the principals of Latera Development, who bought the close to $500 million multifamily portfolio from Aimco. 7 properties, I think 1,500 units. I'm not sure if you're familiar with that trade, but they're seeing 7-8% positive trade outs, 10% cash on cash. But it was a market that a lot of capital has been resistant on. So I guess I want to frame the question this way. There's been a lot of talk of, oversupply in Sunbelt, although you're seeing, the supply come down versus political instability in the coastal markets in California and the Pacific Northwest. Where do you see what keeps you up more at night? The coastal market potential political instability or oversupplied Sunbelt markets?
The political instability on the coastal markets. Oversupply can be thoughtfully, let's call it, managed through. You can
Mm-hmm.
pick your locations. Let's give an example of that. Phoenix. When you say Phoenix out loud, what's the first thing people think? Oh, massive oversupply. It was overbuilt. But those that haven't gone in, there's a big difference between North Phoenix and South Phoenix, East and West. I mean, if you look at the Taiwan Semiconductor construction that's being developed in North Phoenix, that's one of the largest developments in the US, if not globally, that's going on right now. And if you look at the number of jobs that are coming in, et cetera, the demand for supply of multifamily housing is far going to exceed what's going to be presented in that market. So it really gets into submarkets even within cities that we need to be talking about. Political, let's call it, lack of predictability on the coastlines has only it's only just evolved at a faster rate. It's always been there. And look at it, California. People thought we were crazy to go in and start a development outside of San Diego. Why? Because it was just in California. But if you look at the San Diego market, net population growth in the market, net job growth that was in the market, a regulatory framework, yeah, it's considerable, but we've operated in that before. And we were getting a land basis of zero. And we were working through, let's call it, business risk in that environment was very, very low. Unlike a Florida where you have the insurance costs that are just really hard, overwhelming, if you will. They can strip away all of your margin. But California in select spots, because it's so hard to build there, and because it's so challenging to get land at a fair or equitable basis, if you can get that, there's tremendous opportunity, even though you would say the political instability is extremely high.
Yeah.
So you have to really look at it as submarket particularly. And because we're opportunistic, there's some firms that are well-known household names in this space. They have to put capital to work, and they have to put it, I would argue, much more broadly into the U.S. market than we would. And that's a big difference from us, where we don't have to be everywhere. That's why we operate in 25 states where we choose to, and a lot of those states are not coastal. blue states, if you will.
Yeah, let's pivot over to the capital side, and it sounds like you provide both debt and pref equity, mezz, and even JV capital. How are you seeing returns? Because what we're seeing, especially on the pref side, we're seeing yields come in quite a bit from where they were a year or two ago. There's a lot of competition. There's a lot of groups who they may have been operators. They do have capital, or maybe they were equity providers, but they don't want to play in the JV equity space. So they went to they pivoted over to pref, and we're seeing what used to be maybe a 14 or 15% cost of capital for the borrower has now come down to 11, 12%. Is that what you're seeing in pref mezz, or maybe my set of transactions are not reflective of what you're seeing out there?
Broadly speaking, yes, that's what we're seeing. And if you think bridge is where we're spending a lot of time right now, think about that financing, take out original construction debt for new products. We're seeing more competition come into that space. And so we're seeing the rates come in. We're still differentiating ourselves because certainty of execution matters, networks matter, and do they understand what we're trying to underwrite? Meaning, because we're a developer and an operator, it really lends a differentiated sight on the underwriting capacity for us. And a lot of developers and even the banks like us there because we can give them that added insight of, hey, this is what our asset management team thinks. This is what our development team thinks. Here's what our acquisition team thinks. So the price points or inputs are much more broad and deep when Forum comes to the table in terms of underwriting than a lot of firms that are just lenders, if you will. So we might have a higher rate and still win because we're either a risk mitigation factor or an insight factor that they actually look at as a value add. But bridge is where we spent a lot of our time in 25, 26, if you will. We still think construction lending, which is our bread and butter, is going to still continue in 26 and 2027. But yes, we're still seeing more competition come in. It's not uh, the competition is still building its network and defining their value. So yes, they're offering it where we'll see a 10 or 11. We're like, how we're not going to be at a 10 11 on construction. Doesn't make sense, but they're buying the business. But the real underwriting's happening from the sponsor of, hey, this is a great rate, but certainty of execution. Are they going to be there with the capital when we need them? And do we believe this is a long-term partner? That's interesting. And then 2027, we think this is going to be LP capital where we move up in the capital stack. And again, our sizing in terms of our loans, we're not doing a lot of whole loans. We're not at this 100, 150, 200 size where you're going to get a lot of the competition in there. It's going to be very competitive. You get a number of term sheets just float in on day one. But I would say what you articulated and when we started this, my response is accurate. We're seeing lower rates, but it doesn't mean those lower rates are the ones winning the business or being finalized as the partner.
So that my audience does know when to contact you, could you be a little more granular as to, I don't know, let's call it minimum loan amount size that Forum would be interested in transacting from senior construction, pref, JV equity? When should my audience think of you guys?
Yeah, I think 10 to 50, right? 10 to 75. That's the space that we can operate in pretty efficiently. I think my first 10 to 50 is a pretty good space for them to think about us. And one reason we get pulled in by a lot of the banks that are their primary lender is because the banks says, you listen, we want Forum involved here as pref mezz or JV equity, as I'll frame it, because if you do walk away, you step away, Forum can take over that property and finish the project, keep our loan performing, and pass that margin right on through to their investors. And that's a risk mitigation factor that the banks will actually pull us along for. The sponsor will say, I want Forum there because I can leverage their development and their operating expertise of, am I getting the right price points during my construction project on X, Y, or Z? So both parties see us as a value that's really hard to replicate. Hence why sometimes we might not be the lowest rate, but we end up winning the business, if you will.
And is it exclusively on multifamily product, or will you go into the other asset classes?
We've financed pref and mezz at the University of Maryland, College Park on some of their new student housing,
Mhm.
Florida Gainesville, UT Austin, the Ross School of Business at University of Michigan. So student housing, just for examples. Select industrial, we were the pref for the GM EV plant in Michigan. That was a great opportunity for us. The sponsor really knew us well, certainty of execution and the relationship on a prior development was the rationale why we were brought front and center. And we've selectively in retail, but that's a very narrow segment. And that's mostly, if you think about the discovery retail, which is the open air mall structure that's now operating nationally with well-known names, almost kind of a plant of all the same stores, Chipotle, Starbucks, XYZ. We think there's opportunity to grow that network in quote neighborhood retail, but we're not in the big box for the broader refinancings or bridge for the traditional retail for all the obvious reasons. I think all of your clients would know that.
Yeah. I guess last substantive question, and then we'll finish the podcast with a personal question. But are you seeing any impact from geopolitical issues from the war in the Middle East, which is now causing oil to be well north of $100? Rates have not come down. In fact, they've been trickling up over the last several months. These geopolitical headwinds, are you seeing it impact your day-to-day real estate business, whether it's on the operating side, lending side, or equity side?
Yes, you touched on it early. Transaction volumes below where everyone thought it would be. Why?
Yeah.
No matter what industry you're in, political instability creates a lower level of confidence, which means transactions dry up. I argue if whether sitting in real estate, private equity, or infrastructure, it creates that lack of predictability. That's one. Two, a fallout is price inputs. We have said for the last year and a half, we didn't think rates were going to come down. And we didn't think rates were going to, we still don't think rates are coming down. I know there's a lot of noise around it in the marketplace, but when you have this kind of, let's call it political instability, as we'll just simply frame it, rates don't historically trend downward during environments with political instability. And so I don't think that's going away anytime soon. And we would say we don't think rates are coming down. And that was a savior that a lot of owner operator sponsors were hoping. We'll wait till rates come back because I didn't lock in my rates and then we'll actually refinance or sell at that point when we have cap rates compressed. Well, that didn't happen. We still don't think it's going to happen. And cap rates are a bet or a hope, but they're not a plan. So the last comment I'll make about the political instability in the war, cost inputs. Just look at what the cost inputs, and everyone says, well, oil, we don't need it to build. Yeah, you do in a lot of different ways. And wood right now is stabilized, but I'll frame it this way. When the wood mafia, the lumber mafia starts to price that back up because developments start to go back up, that's not going to be an input that's going to be easy to manage. And if we don't create our basis now on development, I think it's going to be more challenging on your cost inputs over the next couple of years. So it definitely has impacted the business. Transactions are slower. We think unpredictability of outcomes is greater. Rates will stay higher because of it, and cost inputs stay elevated.
Yeah, I think those that thought they would get saved with a 10-year treasury in the mid threes, that ship has sailed. I don't see that happening anytime soon.
We would
Um,
agree with you. So we're either both right or both wrong, but
yeah.
not excited to say that. Just that's what we believe.
Yeah, I mean that's our reality. All right, if I recall correctly, in addition to you being an accomplished football player and baseball player, you're a surfer.
Yeah, accomplished is always a relative term, right? Do I
Well,
surf? Yeah, I love it. I love surfing. It's my favorite thing in the world. Quite frankly, sitting on the board and just watching the waves come in is actually the specific most favorite part of the whole experience.
well, sitting in Denver, then you relish your vacations. Then, so tell me, I'm a retired surfer. I honestly feel that of all the sports I've played, surfing is the most challenging sport exercise endeavor ever. I mean, from A, just being cold, B, being concerned about a shark eating me, stepping on sea urchin, which is a true story. I did that surfing, and then just, just getting knocked to hell. But tell me about your, I don't know, favorite surf spot in the world.
Yeah, and it's really that's a sentimental aspect. My boys and I grew up raising my boys since they were 7, 5, and 2, my own, and we would go to this location in Mexico every Christmas break. Me and the three boys, like that's my tribe, and we'd end up south of Punta Mita before Punta Mita became so popular and built
Sure.
out, and now it's a different world. Um, but there's this surf break south of Punta Mita along the coastline that this old boat would take us down to. And it was my favorite because there's three little guys in the water that who knows if they're surfing or standing on their head with on the surfboard and trying to laugh. And I'm just trying to catch these long rollers where it's warm water and just the whole environment. The Mexico people from Mexico are so wonderful, so kind, and they treated us with such sincerity. We would go back every year, and so I that's that one break just has a personal appeal to me that's never going to be shaken because it's just the memories of it being with my boys in that space and the warm water. It's just hard to beat that. So that's my favorite place because of the experience around it and the people that I was with.
No, that's a great story. I love it. Well, I loved hearing all about your background and Forum and the different places that Forum transact in. I'm really glad that we were able to get together and have this conversation.
You were really kind to invite me on. I appreciate it. Thank you for giving us the time to talk a little bit about our story. And hopefully, that your clients took away one piece of value add or one entertaining aspect of our conversation. But thank you, Andrew.
Absolutely. All right. Best of luck to you and the rest of your Forum colleagues. And that's another edition of the Kirsh Connection.